Hey, everybody, and welcome to today's video podcast. I am Denitza Rave, your credit and financial coach. I am doing an impromptu video and podcast on debt to income ratio. So it is impromptu. I didn't schedule it. So I am just going to hold tight for a few minutes and just see if we get any more people to pop into this video podcast. How is everyone's? What day is it today? It's going by so fast. Saturday going. I hope you guys are doing well. My husband has some friends over. They're at the swimming pool for a goodbye party. So I have a few minutes to myself. So I thought I would jump on and do an impromptu video podcast for everybody. If you want to join my Facebook group, it is a private group and exclusive. You do have to answer a few membership questions to be able to join. It's not lengthy or anything or intrusive, just a few little questions. I have in the chat box here the group name. It's for Facebook. It's Credit Repair and Financial Services, and is completely spelled out. It doesn't have the ampersand sign. If you also want to check out my information and who I am and what I do, you can also, and a consultation, you can also visit my website, which I have here in the chat box, bravefinancialservices.com. Okay, give it about another 30 seconds. And then I will begin the podcast. And if you are watching from my Facebook group, Restream, this is the company that I am doing my webinars and my educational videos on. Unless you give them explicit permission to show your face and your name in the comment section whenever you want to ask a question or what have you, you have to actually have the link to do that. And I did post it in the group. Hopefully it is there. And you would just click on it. Otherwise, you can still comment. I learned that I will still see your comments. I just won't see the profile picture, and I won't see who posted the comment. So I won't be able to like say your name and acknowledge you. I'll just see like Facebook user or what have you. Okay. All right. So I will go ahead now and start this video. So as I said in the beginning, I'm Denitza Rave. I am the owner of Rave Financial Services. I am a credit and financial coach. I also do business taxes. I'm studying to do some tax resolution with the IRS. I can already do it for the state of California. I'm just working on it for the IRS. And yeah, I love what I do. I love my business. I have been in the accounting and finance field for about 16 years now. Give or take, it might be a little bit longer. That it just flies by. But yeah, so I've been in the field for a long time. I was a financial counselor for a for-profit university, so I also know and about student loans, and I help with student loan consolidation, repayment, all of that good stuff. So I got into credit repair. One, I find it fascinating. I've been around credit, in the industry for all of my finance and accounting career, right? So I've always found it fascinating, but I didn't really get into it like heavy duty excited about it until we were going through our first home purchase that we recently bought a house in during the pandemic in 2020. So we went through that whole process and I just found it absolutely fascinating. I already knew a bunch about it from repairing my own credit. So I just find it fascinating. So now that is one of my main focal points, one of my main focuses in my business is credit repair, credit restoration, whatever. But I don't do it the shady way. I don't tell you guys or my clients, to go down the list and be like, that's not mine. I don't know that account unless it actually is, because it can definitely blow up on the credit counselor and specialist and also on the client. Okay. You don't want to be going in and making these false, this isn't mine, this isn't mine. And anyone that tells you to do that is unethical and they're not doing things the legal way. I do things the legal way. Okay. So I'm always trying to stay up to date on everything. Policies, education, everything. So that's who I am and why I do credit repair. So today as I said, it's in the little bio. It's June National Home Buyers Month this month. Okay. So I am going to be going on and doing video podcasts over the month of June. So definitely give me a follow or join my Facebook group. So that way you're always in the loop and you know when I'm going to be going live. It'll be scheduled usually, or sometimes I'll just spontaneously get on like I am today. Okay. So as I said, today is June National Home Buyers Month. I am going to be giving lots of value-based knowledge and education, and it's helpful for everybody, but especially for those that are actually going into or thinking of going into the home buying process. My webinars are also good for students because it's an additional learning opportunity. Okay. And I also teach as well. Okay. So if you're a realtor, you can always refer your clients to me as well, and I can help get them and move them on the way to getting that home loan with you guys. Okay. So feel free to contact me if you're a realtor, become an affiliate. I do have some goodies for you. And we definitely work with each other with the client. Once I'm done with your client, they're back to you, straight to you. I will never refer them to anyone else. I am not a realtor myself, so I would never, and even if I was, I would never ever think to keep someone's client. So everyone that comes to me goes right back to you. Okay. So debt to income ratio is what we're talking about today, or sometimes it's referred to as DTI. What that is basically, and you're going to see me looking down periodically because I don't want to miss anything, because all this information is extremely important for everybody to know. And I want to make sure I have all my dots and T's crossed. So the DTI, or debt to income ratio, it's a percentage number. Okay. That tells the lender exactly how much you have to spend on debt payoff. Okay. Versus what your household income is. Okay. So basically, if you have enough money to pay your debt, that's coming in from various income streams. Okay. Debt to income ratio is actually very easy to calculate. All you'll do basically is do a summation. So sum up all of your monthly minimum payments, not your maximum payments that you normally make, but just your minimum payments. And then you're going to divide it. So you're going to slash it in half by whatever your monthly pre-tax income is. And just in case you don't know, pre-tax income is literally like all your total income that you have before you pay any income tax or any other taxes, but after you take any of your deductions. Okay. So for example, suppose your salary is 50 grand, $50,000. If you are taking, say, I have written down here, 10,000 in tax deductions, your pre-tax income left over will be $40,000. So that's the number that we would concentrate on. Okay. Lenders definitely prefer to see borrowers with a lower DTI or debt to income ratio because obviously it shows less risk of student loans. Oh my goodness. The shows less risk of loan default, foreclosures, that sort of thing. Okay. So that number, the DTI number, it actually influences the size of the loan and the interest rate that a home buyer is qualified for. Okay. If you have any questions about that, feel free to put them in the comment section and I can go ahead and answer them for you. Okay. There's two types of DTI or debt to income ratio. Okay. We have a front end and then we have the back end. So the front end DTI, it only includes your housing related expenses. That's it. Just your housing related expenses. So it calculates your future mortgage payment per month, including your property taxes, your homeowner's insurance, and if you're moving into a community that has HOA or homeowner's insurance. Okay. That is your front end DTI. Now you have your back end DTI. Okay. That includes all of your minimum monthly required monthly debts. Okay. All the minimums, not what you normally pay, but just what is minimum on your statements. In addition to your house related expenses. Okay. Which is like all the monthly payments that your lender will find on your credit report. Okay. So that's why you need to have a clean credit report when you go to get approval for a loan, because that your lender looks at all of that. Okay. It's your actual report more than your credit score that the lenders look at. You know, people get so fixated on, I have to have an 850. I have to have a 750 credit score. Yeah, you definitely need to have that. But the lenders look at what's facts, what is on your credit report. Okay. So the prettier your credit report looks, the easier, better chance it is that you're going to get a loan. And if you think about it, a pretty credit report goes hand in hand with a pretty credit score. Okay. So while the credit score is definitely important, it's your actual credit picture that is the most important. That tells your story, your financial story. Okay. So it also includes debts like credit cards, any student loans that you may have, and any personal loans that are out there. Back end DTI is the number that the lenders zero in on, as I said, because it gives, like I said, the actual picture of your spending, of your monthly spending habits. Okay. And if you can pay your bills on time or not. So I'm going to go ahead and provide you with a breakdown of what to include and what not to include in your DTI. And it's kind of a lot. So you're going to see me reading from my notes that I have. Okay. So if you're going to definitely include your student loans. Okay. So basically the way to figure out the student loan calculation, it's pretty simple. So say you have a $20,000 student loan payment, right? Like that would be wonderful to only have 20 grand, but most people have more than that. But we're just going to say 20 grand just to say 20 grand. Okay. And your minimum monthly payment on that $20,000 student loan is $300. So you're only going to include that $300 minimum payment, okay, in your debt to income ratio, just that. Then you're going to also include your rent or your monthly mortgage payment. You're going to add in any homeowners association, like I said earlier, or HOA fees that are paid monthly. You're going to include whatever your auto loan payment is. You're going to include any child support or any alimony payments that you make, any credit card payments, the minimums, and whatever your personal loan payments are that are minimum payments. Okay. Expenses that should be left out of your minimum monthly payment calculation would be your utility costs, your health insurance premiums, transportation costs, so like gas, if you have to take the bus, whatever, savings account contributions, 401k or IRA contributions, and entertainment, food, and clothing costs. So those are expenses that do not need to be in your monthly payment calculation. Now, you want to keep that in the back of your head so that way when you sign up for your loan, you want to make sure you calculate, enough money left over for utilities and insurance premiums and savings contributions and your IRA and any entertainment. You definitely want to keep that in the back of your mind, but those aren't expenses that you would actually include in your debt to income ratio. Okay. So if that makes sense, throw in a comment in saying hashtag makes sense. And if you're finding value in this, go ahead and comment in the comment section hashtag value. Okay. So here's an example of how to calculate your DTI or your debt to income ratio. So say you have rent of $1,500. You have a student loan payment of $300. You have credit card minimum payments. Say all of your credit cards are $200 minimum for all of them. Okay. And then you have your auto minimum payment of $350. So the 1,500, the 300, the 200, and the 350, that all adds up to a monthly payment of $2,350, right? You can easily plug that into your calculator on your phone, or if you have a calculator near you, and verify that I did calculate that correctly, which it is, but you can also verify it yourself. So you're going to add all that up, all those monthly minimum payments. Then you're going to divide that monthly payment by your gross monthly income. So it would be your gross monthly income and anyone else that's going to go in on the loan with you. So your spouse, or if you're going into a house with your mom or your parent or friends, what have you. Okay, so you would have to include their information as well in that, including their expenses. So once the total gross monthly income for everyone on the loan is accounted for, okay, you're going to divide the total minimum monthly payments by your gross monthly income. So when you do that, you're going to then convert that percentage of what you divided into a decimal. Okay. So you're going to convert that decimal that you got into a percentage amount. Okay. So to see the DTI, you're going to multiply. You're going to have to go back to your grade school math. You're going to multiply that decimal by 100. Remember, to get the percentage of that decimal. So say your monthly gross income that I have here is $5,000. Okay. You're going to divide your expenses of the $2,350 that I mentioned earlier by 5,000. And then you're going to get, once you divide the 2,350 by the 5,000, you're going to get a decimal. Okay. You're going to get a decimal of 47. Then you're going to multiply by 100 to get 47%. Okay. So your end result means your debt to income ratio is 47%. Typically lenders, excuse me, my throat's dry. Typically lenders like to see a debt to income ratio of 43% or less. Okay. So each loan type has a specific DTI that you need to be at. So if you're a first time home buyer, you can qualify for the FHA loan, right? The maximum debt to income ratio, so the maximum debt that you can have is 57%, but then it's also on case by case basis. So it could be a little bit more. It just depends on what's happening. Okay. Many people don't know, and I had no idea about this until I started looking into the home buying process, The USDA offers home loans, believe it or not. But your DTI has to be less than 41%, among other requirements that definitely go beyond the scope of this video podcast. Okay. You would want to go ahead and look into that yourself. The VA loans, if you're a veteran, okay, you can have a debt to income ratio of 60%, up to 60%. But just like the FHA, it's case by case basis. Okay. And then you have your conventional loans. Okay. Those you want to have typically a DTI of 50%. So 50% or less, but there's also caveats with that for people with a higher debt to income ratio. Okay. So now that you have all that information, you may be wondering, like, gosh, Denitza, how do I lower my DTI, my debt to income ratio? Well, first of all, you're going to want to pay off all of your small debts first. That is actually the easiest way. It's what I did. It's the easiest way. Excuse me. The fastest way, the way with less stress. And for most people, it's the most economical, feasible way of lowering your debt to income ratio. So if you have a credit card that has a balance of $200, pay that off first over the credit card that has a $10,000 balance, okay? And then just work your way up to that. And then if possible, kind of do like the snowball effect if you want to, where you paid off your $200 credit card. So that $200 gone. So put that $200 towards your next payoff credit card and then just go on from there. Okay. That's always one way of doing it. Obviously, you can increase your income. Okay. So you have a 9-to-5 job or a W-2 job, add an extra income revenue. So go do DoorDash or Instacart or get a second job, things that can increase your income. Okay. Lenders like to see at least a 2-year minimum history of income source. Okay. You can also get a cosigner on your loan for that. Okay. So if you guys have any questions on that, let me know. I'll go ahead and sit here in the chat for a minute and see if any questions come through. And I apologize, my throat is like super duper dry right now. Okay, so if you have found this valuable, definitely let me know. The definitely hashtag valuable in the comments. Hashtag financial education. Because the reason why I say hashtag is that way it gets this information out to more than just you watching the video. Okay. So the more comments, the more activity, the more hashtags that are there, it helps the algorithms move along the video. So that way, not only are you soaking up all this valuable information, but other people are too. Okay. So that is it. That is all I have for you today for debt to income ratio. Okay. For June Home Buyers Month. Again, definitely follow me on my Facebook page, or my Facebook group page, I should say, Credit Repair and Financial Services. This month, we're going to be going over budgeting. We're going to be going over mortgages. This video here, debt to income ratio. We'll go over credit. We're going to go over the do's and don'ts of home buying and when looking for the home. I also have DIY credit repair. So you can always do your own credit repair. I have letters for you. You can just go ahead and go to my Equid store, Ray Financial Services, and you can go ahead and buy the stuff there. Or you can get it off my website, rayfinancialservices.com. I have a bunch of stuff on there, and I build my library every day. If you want to keep abreast of anything that's happening, please go ahead and message me your email, or email me at denitza@ravefinancialservices.com. I'll go ahead and put that in the chat box right now. Okay, that way I can go ahead and get you on my email list. And I do send out freebies oftentimes, and I do have freebies via my Facebook group page. I also have fun little like contests that I run. Like the other day, I ran just a little question contest type thing. Who will answer first? Whoever answers first gets a free coffee on me and stuff like that. So, anyway, thank you so much for joining this educational video. I hope you found it valuable. Feel free to visit me at my website. Feel free to request access to my exclusive and free and private credit repair and financial services group. Okay. And if you have any questions or comments, anything you want me to talk about, anything that you want to just me to talk about with you personally, definitely let me know. Shoot me an email. Okay. If you are interested in credit repair services, definitely give me an email, and I can go ahead and help you with that. I can also give you information on DIY credit repair if you want to do it yourself, because I do have the tools for you. If you are looking to consolidate your student loans, if you're going into student loan repayment soon, definitely let me know, and I can help you in all aspects of student loans as well. So give me a follow, and you can also look me up on YouTube as well, Ray Financial Services LLC. I look forward to seeing you all and learning and teaching you guys all again soon. Thanks.